Hi, I'm Tyler Ballhorn, and this is the Stock Scores Market Minutes for February 1st, 2016. This week's topic, have patience with winning trades. It's part of being a normal human being to sell your winners too early because of fear that the winners will lose value, even have a winner turn into a loser. And so the natural tendency is to sell those winners too early simply because we don't want to give back profits that we've made. Now, I've been doing some research recently, and one of the things that I found is that the greatest impact on the profitability of a strategy comes not by having the best entry or by picking the right position size. It is really all about being patient with winners, to not get shaken out of stocks because of some minor weakness, to wait for a true turn in the trend and not simply a pullback against the trend. Pullbacks are normal, and they are designed, I would say, by the market to shake you out of a position only to have that position move higher. And so it's really important to not ignore weakness, because sometimes weakness is a turn of trend, but to have the patience to stick with the minor weaknesses that does not break the trend. And of course, you can flip that all upside down with short selling positions as well. Be patient with your winning trades. It has a huge impact on your overall profitability. All right, let's get into this week's analysis. And something that's been happening over the last 4 or 5 days is that the U.S. stock market in particular has been stabilizing. You can see that we've got the build of a rising bottom here. And again, this is the 13-minute chart. The 30-minute chart going back half a month or so, or actually go back a whole month. And so you can see there we built a rising bottom from this one. And then at the end of last week, Friday, we broke out of that. Monday, we had some follow through. So what this really tells me is that it's starting to become a time to swing trade again. For a long time, I've been saying if you're a longer term trader, position trader, swing trader, you want to be sitting on your hands. But and really day trading was the only kind of game in town for the duration of the correction. We're now starting to see the market stabilize, which makes it possible to get a little bit more of a trend, not so much whipsaw action back and forth. And so I think if you like to swing trade, you can start to come back to the market, particularly the U.S. market. However, if you're a position trader, I'm still not real confident because we are still below the trend line. Now, this is a weekly chart going back 3 years. Our trend is something like that. You can see that we've basically held support here so far. And it's really expected that the market would bounce there. So I don't think we can call this a great positive that we're seeing a little bit of green on these weekly bars. The market could simply go up like this and then break down and continue further lower. I'm still concerned that we have that falling top. And so until that falling top line is broken, until this upper trend line here is broken, position traders should still remain pretty cautious and very selective. On the Russell 2000, you can see that strength is also below the downward trend line and really well below the downward trend line. So there's lots of short-term upside potential here, which is why swing trading maybe is something we can be doing again. But for the position trader, you're still fighting against this pessimism that's been building for a few months. And you got to be pretty selective if you want to take longer-term trades. The Canadian market came back pretty nicely in the last 5 or 6 days, mostly because oil stabilized. Oil was weak today. We'll see that in a moment, and you can see the effect it had on Canadian stocks. There's today's trading action, and it really broke this little upward trend line that had been in place, however, not from a falling top. So this may just be a pullback. We'll wait and see how that materializes, but I want you to be a little more cautious in the short term on the Canadian market because of that. Within the context of the longer term time frame, this again is the 3-year weekly chart. I'm not drawing my lines very well, but you get the idea. We're still below the downward trend line, and that's why I say as a position trader, you really don't want to be aggressive at all. You want to be sitting on your hands, be patient. The time will come. It always does. But for now, don't jump into this market and take longer term trades just yet. You can start to nibble, but do it more as a swing trade, which may evolve into a position trade if it works out. But you still want to be watching it like a swing trade right now. TSX Venture, a little bit of strength last week, but still well below the downward trend line or in the downward trend. Really no reason to be too enthusiastic about at least the commodity stocks on the TSX Venture. There are some tech businesses on the TSX Venture that are able to overcome that downward trend. Here's the Treasury bonds. You can see money sort of flowing back into the bond market, mostly as a safe haven right there. Kind of broke this downward trend line, did so from a rising bottom. So that points to higher bond prices, which means lower interest rates. We'll see if it holds. It's coming into some resistance here now, so I expect it will stall for a week or two at least there, and we can see if it ultimately breaks through and tries to make another run toward the highs of early 2015. US dollar showed a little bit of weakness to start the week this week and was kind of mundane last week. A little bit of volatility there, obviously, when the Japanese decided to go to negative interest rates. That is tough on the yen and gives some support to the US dollar, but it didn't have a huge effect in terms of this chart because on the weekly chart we're still stuck inside this pennant pattern right now, and that's essentially a consolidation pattern. That's confidence building. The trend should break up because the trend into the pennant was up, so you can see trend there into the pennant. That means most likely we break up to the through the top part of the pennant there, but hasn't happened yet, so we'll see how that materializes. If that does happen, that's a negative for commodities and will harm oil even more than it's already feeling weakness. Now, I'm supposed to have the gold chart here, and unfortunately I put the wrong chart in, but basically gold, been rallying for 3 or 4 weeks, has come up to the downward trend line. So I think the long-term downward trend is going to resume, and therefore I would be pretty cautious with oil, or pardon me, with gold, looking out into this week because it has rallied into resistance where it's likely to get stuck. Now, it's had a pretty good little run the last little while, so it might break the trend, but I just don't see the signs there yet. So stay cautious on gold. I've been obviously bearish on gold for a very long time. Here's the U.S. oil chart. This is the daily chart. I wanted to show the daily because what's important today is that it broke a flag pattern. This is a flag right here, and this is the downward trend line. So what essentially has happened, and again, I apologize that the line is so crooked, but I usually have a pen to do this, and today I'm kind of doing it freehand with my fingers, so it's not working as well. But there you can see the rally into the downward trend line. Picture that as a straight line. It's obviously not very well done. Essentially what happened was oil was oversold here because it had run down and away from the trend line. Now it's come back up to the trend line. It hit the trend line, and not much of a surprise today it broke down. That points to a retest of the lows. Now, if it can build a rising bottom here and then break the downward trend line, hey, finally we have a reason to be optimistic on oil. But that is not what is happening now. That is not what will probably happen. It was what might happen. It's a possibility, but not a probability. So my expectation is we retest the lows on oil. 65% chance, I would say. 35% chance as we build a rising bottom here and maybe make a stab at breaking that downward trend line. Here's the fear index coming off a little bit as the market stabilized, but still at an elevated level. And, wouldn't surprise me that we see a little more pullback in fear, a little bit of a rally in stocks. And then if oil hasn't stabilized, we could get the selling pressure going all over again, and that'll bring the fear index up. So we're not out of the woods yet by any means. Therefore, my outlook, U.S. stocks, I put neutral on both time frames. I could easily go bearish on either time frame because we are building pessimism longer term as well as coming into some resistance in the short term. But I've given the market the benefit of the doubt with neutral ratings for US and Canada because it is trying to stabilize. Gold, bearish long term. I've got neutral short term. It has rallied in the last week or two, but coming into resistance on that downward trend line where it's going to roll over and probably move lower. Oil bearish on both time frames. We just had that breakdown from a flag. That's a bearish signal in the short term. The markets have been making an attempt at stabilizing, and there may be some swing trades in stocks in the near term. However, stocks have not yet broken their downward trend, so remain cautious, particularly if you're a longer term trader. Oil starting to roll over again, and gold's short-term rally is now hitting resistance at the downward trend line. Reason to be cautious. That's been the Stock Scores Market Minutes for February 1st, 2016. Have a great week in the market and trade well.